Greetings. Hi, my name is Keith Prather, and I'm here to give you an update on the March Automotive NCM Index, and just to give you a few of the highlights from the report. So a couple things from the index this month. We noticed that we had an increase overall, so we were up 6.1% year over year. And again, this index measures demand overall. So there's another side to the equation, which is the supply side of the automotive sale. If you think about automotive inventories and the available models that customers want to buy, but the demand side is what we watch, and demand can be strong, and at the same time, we don't necessarily see dealer traffic. And the reason for that may be that consumers are feeling like they need to spend and they want to spend, but other factors are holding them back just a little bit from making a purchase. Could be unavailable models. There are a lot of factors that could go into this, but we just want to let you know that the demand environment still looks pretty stable for automotive overall. So again, up 6.1% year over year, and then between January and February, up about 2.4%. It seems like we have about a 30-day lag here between the index and trying to get all the economic data in, being able to create it. So still pretty good. And the important thing to do is look at it historically. As we look at it historically, it's at a level that is pretty elevated. So if we go back, it's better than the 2014 to 2018 period. So that demand level is stronger, but not as strong as it was, maybe back in the cash for clunkers area, in the period that we saw from February of 2010 through about February of 2014. So kind of gives you just an idea of where that relative demand would be. Again, if the economy were going into a recession, the index would be showing it below the 50 level. And we don't see anything close to that in this particular series. A couple other things that I did want to point out, and I'm just going to get to work. There we go. There is another factor in the economy right now that's maybe explaining why some of you are feeling fits and spurts in sales. We are going through a non-traditional type of recovery. So normally we would get a V-shaped recovery coming out of an era like the pandemic and a deep recession. And that V-shaped recovery would mean that most segments of the economy recover and move together. But what's happening this time is we're getting this K-shaped recovery, and experiences based on household income levels are very different. So for instance, the upper income household levels are doing very, very well. I mean, stock market profits are hitting all-time highs. They've got a lot of cash, a lot of wherewithal. They've made a lot of income. Their wages are stable. The jobs are generally stable. And so that's why we see some upper level vehicles, some higher cost vehicles still selling really rapidly, even though overall sales may be a little bit sluggish in some areas. So companies also that kind of fit that category, where companies have done very well, extremely well, have low debt thresholds. A lot of them will be investing in replenishing their fleets and spending and still investing overall. The lower income then also is an area where these are going to be some of the lower cost used cars, maybe some low entry level cost new cars, but households that are generally under $50,000 in income are finding it very difficult to get by. So inflation has hit them very hard over the last 2 to 3 years. 85% are currently living check to check, according to Lending Club. And this area of the economy continues to get hit by just multiple waves of influences. So when we think about automation, we think about AI, it's typically this level of worker that may be a little less educated, maybe have a little less specific skill training, where AI is easily replacing those repetitive types of positions. Something as simple as automated checkouts at a big retailer would be an example of how some of these part-time and hourly wage jobs are getting replaced by technology. And so this area of the economy is getting hit pretty hard from that. It's the middle income segment where we really see kind of a battleground, because we have really two segments of the middle income. The upper end of that is actually doing very well and kind of performs a little bit like the upper income households. And so these folks are still shopping. They're still looking for vehicles. They're looking for bargains, but at the same time, they're still willing to spend and willing to take on debt. The lower portion of the middle income class is still struggling a little bit. So 55% now living check to check makes it very difficult for them to take on a large car payment. And so we still see some of those challenges with that segment of the market. So if you're feeling that the dynamics on showroom floors are on and you're having a difficult time kind of reconciling, it's okay because that's what we're feeling across the entire economy, and it's because of this dynamic, this K-shaped recovery. This is also why we're heading into political season. It's also why we can hear one camp say that wow the economy is booming and doing fantastic, while another camp says it's really struggling and people households are struggling. Both are correct, to be honest. Depends on what segment of the economy you're in right now. So the last thing I wanted to show you is just very quickly, because this sort of sets up the future when it comes to production, is just auto inventories relative to sales and where we are in the sales cycle. So automotive sales in the black line show that we're still hovering pretty good, just over 15 million annualized unit sales, which is a pretty good rate. If we could look back historically, prior to the pandemic, we were running at about a 16 or 17 million unit rate. So we're a little behind, but some of that could be due to this problem. So this is the inventory to sales ratios, and it just shows where inventories are sitting relative to sales volumes, and we're still really what we'd call underweight. We still don't have enough inventory on dealer showroom floors to be able to meet current demand, and that pulls back and restricts sales a bit. So we have that dynamic still working. So OEMs are still working very hard to try and get inventories back up where they need to be, especially with those models that are in high demand that are still short supply. But that dynamic is still working its way through the marketplace. So those are just some highlights from this month's report. I hope if you haven't read the report that you will check it out with NCM. And we look forward to talking to you next time. All right. Take care. Bye bye.